Hello, investment putts, back with you again. I thought I should go over the stocks that I'm trading the option wheel. What am I trading and why am I trading it? So this is my option screener, sorted by the 10 stocks that I'm currently trading. Of those 10, I'm only long 2 of them, so I'm selling covered calls. On the other 8, I'm actually selling cash secured puts presently. You can download this option screener. Just see the link in the description. These are my sector allocations. I've got a $25,000 account and have a much larger retirement account that's conventionally allocated. So the options wheel is a hedged bullish position. I see a lot of guys trading the wheel on a bunch of momentum unicorns. No diversity at all, and that's a very one-sided trade. I want diversification and I want to minimize correlation with the S&P 500. My main screening criteria is cost versus benefit. It's the share price or cash collateral that I have to hold divided by the options premium for a 2% out of the money call, in this case that expires in 10 days. So among the stocks that I'm trading, you can see a huge variation in that cost versus benefit measure, all the way from 15 down to 122. You have to balance the benefit against the risk of the stock dropping precipitously. I only want to trade shares that aren't overvalued. My valuation metric is the pre-COVID premium, which is simply the price on February 20th, 2020 divided by today's stock price. I believe that the economy is worse off now than it was before COVID, so I expect my stocks to be cheaper than they were before COVID. 6 of my 10 stocks are cheaper than they were before COVID, but 4 are more expensive. These I hold for strategic reasons. First stock that I'm trading is US Steel, and to be honest, this stock scares the crap out of me. It's overvalued and it's unprofitable, but it's been on a tear and it pays really big premiums and has, decent options volume. I don't have a strong strategic reason for holding this stock, so I'll probably get out of it soon. Next is American Airlines. I have to thank JC Gilbert for showing me this one. You might argue that an airline should be more than 25% under its pre-COVID price, but I'm personally confident that air travel will recover to within 80 to 90% of its pre-COVID peak within a year. I'm also doubtful of another crash in the airlines, no pun intended, but the high options premiums are telling me that the market is pricing in another crash, so there's an opportunity. Occidental Petroleum was punished for an ill-timed acquisition of Anadarko, but it's a good oil company and it pays really good premiums right now. Schlumberger is the world's premier oilfield services company, and it's already been terribly punished over the last 5 years, but it's not going away. Wells Fargo gives me some exposure to the banking sector and still pays a nice premium. Cameco is the world's largest uranium miner, and it's the only viable way for a person like me to play uranium, which I'm bullish on. If you realistically want to electrify transportation without burning natural gas or coal, you need nuclear, whether you like it or not. Intel is my nominal tech exposure. That said, compared to a lot of the high flyers, Intel has a PE ratio of 12 and pays a pretty nice dividend. Walgreens isn't going anywhere and it still pays a very nice options premium. I have a strategic position in precious metals. GDX is the best way, in my opinion, to trade gold. SLV has recently been rising with high volatility, though recently the options premiums have decreased. I'm currently long both of these ETFs, though I may get out of silver unless the premiums improve. So here's what you've probably been waiting for. Here's the performance of my $25,000 portfolio over 2 months in the blue curve. I'm up about 4% in 2 months, or 24% annualized, which is pretty good. The red curve is the S&P ETF, which has been flat, and the orange curve is a 60-40 portfolio of SPY and AGG, which is the aggregate bond ETF. It's actually done worse than S&P SPY. I'm very pleased that my P&L curve is much less volatile than SPY or the 60-40 portfolio. and of course it's gone up. So yeah, I know maybe there's a couple of you listening now, but really the reason I have this channel is to get feedback, critical feedback on what I'm doing, what I'm trading, ideas, share some ideas. I think if little guys like us share ideas, we're not gonna break the market. So blah blah blah, like, subscribe, whatever, but leave comments more importantly. See you later.